Here's a hard truth most people don't find out until it's too late. The state you choose to retire in could quietly drain thousands of dollars from your Social Security, pensions, and investment income every single year. Some states even tax retirement income more heavily than your working income. And if you're not careful, you can end up paying far more than you ever planned for. But the good news, there are ways to reduce or even eliminate these state taxes. And you don't necessarily have to pack up and move to Florida to do it. Hi, I'm Mark Wisniewski, president of Southern Incomes. If you're planning for retirement, understanding how your state taxes Social Security, pensions, and investments could save you thousands. Today, I'll show you which states can be the hardest on retirees and how to keep more of your hard-earned income no matter where you live. If you find this helpful, make sure to like and subscribe for more retirement planning insights. Part 1, why your state matters more in retirement. When you're working, state taxes are often just another line item on your paycheck. Your employer withholds them automatically, and let's face it, most people don't give it much thought. But in retirement, things work differently. And that's where surprises can happen. Think about it. Every dollar you pull from Social Security, pensions, IRAs, 401ks can be taxed differently depending on your state of residence, right? Some states will tax your retirement distributions just like they taxed your salary. Others might tax your Social Security benefits, and few rely on high property and sales taxes that quietly eat away at your retirement budget. Here's an example. Imagine two retirees, both pulling $80,000 a year from their retirement account. One lives in Florida, which has no state income tax. The other lives in California, where withdrawals could be taxed at rates as high as 9 or 10%. That's potentially $8,000 a year from just that one account. Money that could have stayed in their pocket. Now, layer on property taxes, sales taxes, and the cost of living, and suddenly the difference between the two states can add up to hundreds of thousands of dollars over a 20 or 30-year retirement. This is why your zip code matters so much more when you're living off your assets instead of earning a paycheck. But here's the good news. You don't have to uproot your life to make smarter tax choices. Years ago, people tried to beat taxes by running their money through tax shelters in the Caribbean and Macau and Europe. But today, with the right planning, you can often minimize these costs even if you stay right where you are. Part 2, the worst states for retirees and why. Here's something most people don't realize. Retiring in the wrong state doesn't just mean higher income taxes. It can mean higher taxes everywhere, on your Social Security, your pension, even the groceries you buy, and of course, the home you live in. Let's break it down. Some states fully tax Social Security benefits. Others treat withdrawals from your IRA or 401k as ordinary income with no special breaks for retirees. And a few pile on sky-high property and sales taxes that can quietly chip away at your retirement lifestyle. Here are a few states where retirees often face the biggest challenges. California has some of the highest income tax rates in the country, up to 13.3%, and there are no special deductions for retirement income. So, if you're pulling money from your 401k or your IRA, it's taxed just like your old paycheck. Vermont taxes Social Security benefits and other retirement incomes heavily. For retirees with moderate to high incomes, the tax bite can feel especially harsh. Connecticut is one of the only states that fully taxes pensions, 401ks, and IRA distributions for many retirees. Combine that with steep property taxes, it's easy to feel squeezed. New Jersey doesn't tax Social Security, but it taxes other retirement income, and it has some of the highest property taxes in the country. New York offers limited exemptions for retirees, but between income and property taxes, the total burden can be substantial. And these are just a few examples. Other states have creative ways to separate you from your assets, and they could just as easily have been included on this list if we continued on. So here's a story to bring it home. I once met a couple, let's call them Dave and Linda. They retired in New York, and they'd saved diligently and thought a little less than $2 million, I think it was around $1.7, $1.8 million, would be enough for them to support their retirement lifestyle. But between state income tax on their IRA withdrawals, property taxes on their home, and higher sales taxes on everyday purchases, they were paying close to $25,000 a year in state and local taxes alone. He said, I feel like we're going backwards every year. They hadn't realized how much of their retirement budget would be eaten up by taxes. And it wasn't because they made any bad decisions, but because they never thought to plan around their state's tax system. This doesn't mean you can't retire in one of these states. Not at all. No, no, no. It just means you need to plan carefully and understand how your state's tax laws are going to impact your nest egg. And if moving is an option, even relocating for a few years can make a surprising difference if you can. Part 3, how to minimize state income tax without moving. So, what if you already live in one of these high tax states and you're not planning to move? The good news is there are ways to reduce the impact of the state taxes on your retirement income. Let me show you how one retiree did this. A real-world example. Take Karen, a 63-year-old retiree living in Connecticut. She planned to pull $100,000 from her IRA to supplement her Social Security. But when she ran the numbers, she realized Connecticut would treat those IRA withdrawals as ordinary income, and she was going to lose almost $7,000 a year to state taxes alone. Here's how she reduced her tax burden. Step 1, Roth conversions before retirement. She worked with an advisor to start converting portions of her traditional IRA into a Roth IRA several years before she retired. Yes, she paid federal taxes on the conversions, but future withdrawals from the Roth would not be taxed by Connecticut or the federal government for that matter. This locked in tax-free income for her later years. Step 2, strategic withdrawals. She also created withdrawal strategies to stay within certain income thresholds. Instead of pulling a big lump sum, she spread out her IRA distributions carefully over several years to avoid bumping herself into the highest state tax bracket. And this helped her keep more of her money and avoid triggering higher Medicare premiums. Step 3, consider property taxes. She decided not to downsize her home immediately, but doing a little bit of research on Connecticut's property tax relief program for seniors, she applied early and secured a modest exemption that trimmed her property tax bill. What does this mean for you? Even if you're not planning to leave your state, you can still use strategies like Roth conversions during low-income years, withdrawal timing to avoid higher brackets, and leveraging those state-specific tax breaks for retirees. The key is to start planning before you retire, or at least before those required minimum distributions kick in for you at age 73. Here's the bottom line. The state you retire in doesn't just affect the weather or your zip code. It can have a massive impact on how much of your retirement income you actually get to keep. But with the right planning, you don't have to let high taxes dictate your lifestyle. You can create a strategy to protect your income, minimize unnecessary taxes, and give yourself more freedom, whether you decide to stay put or move somewhere new. If you're within 5 years of retirement and wondering, how will my state's tax laws affect my income? Should I consider Roth conversions or relocation? How can I make sure my money lasts as long as I do. That's exactly what we help our clients figure out every day. Book a call with me using the link in the description. Let's build a retirement income plan that's designed to work for you no matter where you call home.